Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to just talk through a few of the things, a few of the questions and other considerations that you might want to think through when you start trying to decide what types of retirement vehicle you want to invest in. Now, I've done a number of videos even to this point on retirement vehicles. I've done videos where I have just concentrated on the 401k or the 403b or the 457b. I've done videos talking about traditional IRAs and Roth IRAs, and I've even done videos on some of the top three. I did one that was a composite talking about the 401k, the traditional IRA, and the Roth all in the same video. I've talked about other retirement considerations, and I've touched on what I'm going to touch on today. I touched on it in other videos, but I thought it would be kind of a good idea to just draw some of these threads together and do a video just separately on that. So the considerations that I kind of wanted to raise here are going to be several number of things. First of all, when you're thinking through what type of retirement products, what type of retirement vehicles you want to utilize, first question is, what retirement vehicles do you have access to? Now, this seems like an obvious question, but if you don't know the answer to that question, you want to investigate what is available through your employer, for example. Do you have a 401k? Do you have to wait a particular time before you contribute to it? Do you have to wait a particular time before you are vested in your employer's contributions? Probably you do. Another related question is going to be, what is your time horizon? Time horizon is kind of the idea of when do you plan to retire? Aiming at retirement, as I've said in other places, is like trying to aim at a moving target. There is going to be the necessity of tweaking. It's like you are a sailor navigating sometimes very choppy waters, and you're going to have to adjust the sails and that kind of thing. So as you aim towards a retirement date, you may have to push it back, pull it forward. You may have to do certain things. You may have to rethink your retirement plans depending on how your different retirement vehicles pan out and other things along the lines of that. But the time horizon is going to be very important when you're thinking about things like the Roth IRA. If you do, let's say, a Roth conversion, there's a 5-year, and this isn't a video on the Roth, but if you do a Roth conversion, then you're going to have a 5-year clock that's going to start ticking on each of the conversions. So if you are 66 years old and you plan to retire at age 67 or age 70, you should bear in mind that if you do a Roth conversion at that time, you may have to wait until age 72 before the money in the Roth, the gain in the Roth, is available in terms of its tax-free benefits that are consistent with and basically constitute the heart of why the Roth IRA is attractive. So those are some considerations that just right from the beginning. And if you are thinking about your employer plans, do you have a 401k? Do you have a 403b? And again, does your employer match? So for many 403bs, the employer does not match. For many 401ks, the employer does match. Now, this is going to make a difference in terms of where you choose to place your retirement dollars. And you should be aware that there are alternative vehicles to the 401k, to the 403b. I've done another video just recently on the question of whether or not you can over-contribute to your 401k. And it's kind of a weird way of thinking about it, because on the one hand, when you hear over-contribute to the 401k, some people hear the question of, can you put too much money towards your retirement? And of course, I think the answer to that probably is no. It's not going to be the case. You're going to put too much money towards your retirement, obviously, unless you undermine your own ability to get to retirement in virtue of not being able to afford a place to live or something. But realistically, the question of can you overfund your retirement, though, is different from the question of are you overfunding a particular vehicle. And to just kind of get into one of the other weightier questions, it's going to basically be, what do you envision your tax situation being? What is your tax situation now, and what do you think your tax situation will be in the future? This is going to expose the speculative nature of some of these questions. Obviously, some of them are hypothetical in the sense that we don't know what the tax laws are going to be. Going forward, the Trump tax cuts, and I'm recording this in 2019, Trump's tax cuts sunset at the end of 2025. And at that point, if they haven't been changed prior to that through some act of Congress or God knows what, then the tax rates will be readjusted. And so some of the different retirement vehicles are going to vary depending on how they are treated in terms of taxes. So for instance, the 401k, 403b, 457, and the traditional IRA, they both essentially work usually like this. The money you put into it, your contribution, is going to be tax deductible. You get a tax deduction when you put money in. Then the money is going to grow tax deferred, and then you are taxed on 100% of the money when you take a distribution. That's generally the way they work. Now, there are a number of things that can cause changes in that. And so for individual and more detailed information on these, I invite you to click on the videos that I will put a link in the description, but I invite you to see the videos where I have dedicated information about the 401k, traditional IRA, and so on. But in general, these employer-sponsored plans, like the 401k and the traditional IRA, are going to basically be pre-tax dollars. You're going to fund them with pre-tax dollars. You're going to use salary reductions, deferred compensation. You're going to do something that's going to essentially cause this cash to be put into that vehicle, and then you are not going to pay tax on it until you take it out. That works well if you believe that your tax rate now is higher than it will be in retirement. So if you think your tax rate is going to be better in retirement than it is now, or you think your tax situation in general is going to be more favorable for you in retirement, then these vehicles are exceptional. That's what they're designed for. And again, I get into that more in detail in the dedicated videos. On the other hand, the Roth IRA, and in some cases if a person is using a life insurance product as a retirement supplement or as part of a life insurance retirement plan or a LIRP, then these dollars are mostly going to be post-tax dollars. That is to say, you are not going to get a deduction on money that you contribute to a Roth IRA. And if you do a Roth conversion, then you go from a vehicle that was tax deferred and had never had taxes paid on it into paying taxes on whatever money you convert and then dumping that into a Roth to grow, hopefully tax deferred, so that you can get the withdrawal, you can get the distribution without paying any tax even on the gain. Why would you favor a Roth IRA? Well, if you think your tax situation is going to be worse in the future for you than it is now, then it would make sense to settle up taxes now. For many people, when they think about their tax situation now, the idea is they're in their earning years. When they retire, they'll take a pay cut, so they think, well, of course my tax situation is going to be better in the future because I'll be in a lower tax bracket. But the joker in the deck there, the wild card, is essentially this, that Congress can raise the tax rates on every bracket. And if Congress raises the tax rates, even if you're in a lower bracket, you may be paying a higher effective tax rate in the future. And there are a number of considerations here, and again, I get into those more in the video on can you over-contribute to your 401k. But here, the idea basically is diversification of taxes is one way to think about it, and the idea there would be you're trying to diversify. If you have all of your assets, retirement assets, in a bucket that is designed to be taxed later on, you're not diversified from a tax standpoint. Now, we know about diversification, or at least we hear about it from the standpoint of market risk. Yeah, you don't want to invest everything in Netflix or Amazon or Bitcoin, no matter how great you think these investments are. You don't want to put all of your eggs into that basket, because then you are not diversified from the standpoint of market risk. There are different kinds of risk, to be sure. There's market risk. That is the risk that the market is going to decline, that the value of one or more of these stocks is going to plummet, and that you're going to lose some of your principal. The idea there is if you spread the risk around by investing in multiple stocks or investing in a basket of stocks, something like a mutual fund or an index fund, then you're going to be mitigating your risk by spreading the risk out over multiple companies. The idea there being that if one company or one sector declines, you will have money invested in other companies or other sectors of the market that don't decline at the same time, or hopefully are unlikely to decline at the same time. And therefore, the loss that you experience is either going to be reduced, or you can even end up with a net gain if some of these other sectors increase in value. That's the idea. There's no guarantee on any market-connected vehicle. There's no guarantee that it's going to increase in value. There is attendant risk. One of the questions you have to ask yourself is, how comfortable are you with risk? Now, when you ask this question, you do have to realize that there are other kinds of risk besides market risk. Market risk is one kind, but there's also institutional risk. That is to say, there's risk that a particular company might fail. So if you are using a life insurance policy, let's say, as part of your retirement plan, and the life insurance company goes out of business or experiences financial difficulty, then you'll realize that there's more risk than just market risk. But more straightforwardly, if you put your money into a bank and your bank fails, there again, in the 1980s, there was the failure of savings and loan institutions. And these S&L institutions, the failure of them speaks to the point that there are more kinds of risk than just market risk. Well, let me say one other thing about risk now. In many cases, you will find that there is a inverse relationship between risk and security of principal or safety of principal. So the more risk you have, the more potential you have for gain, the less security or safety you have in terms of your principal. Now this can apply to many different vehicles. It can apply to stocks. So the stocks that can just have out of control gains, penny stocks, and more speculative kinds of ventures are also going to be the riskiest types that you can invest in. Similarly, junk bonds and bonds in corporate bonds that are related to companies that may not have the most sound financial portfolio may also possibly yield a higher rate of interest or higher return, but at the same time, there's an attendant risk. If you are not willing to accept that risk, and you want your portfolio to be more and more secure, then the trade-off is that the potential for gain gets reduced as well. So the more conservative you are in your portfolio in terms of security and safety of principal, the less possibility you have of experiencing the kinds of gains that some people think of as the main benefit of putting your money into the market. Having said that, there also are considerations related to your age. The older you are, the less time you have to recover from a market decline, and therefore you might think the more incentive you have to place your money into more conservative vehicles. So another question that you have to ask yourself is, how much risk are you prepared to put up with? Sometimes it's stated in a kind of a financial rule, a heuristic called the law of hundreds. Basically the idea here is your age becomes a percentage. So if you are 30 years old, then 30% of your assets should be mitigated in terms of risk, very low risk, out of the market, for instance, and 70% of your assets can stand to be in the market at age 30 because you still anticipate having to work 30 or 40 years until you retire. A market decline at the age of 30, while it is unfortunate, nevertheless still affords you 3 or 4 decades to hopefully regain and end up in a better place. Whereas if you are 70 years old, then according to the law of hundreds, your percentage of safety should be 70%. You should have 70% of your assets out of the market or disconnected from high risk types of vehicle and only 30% in. And again, these are just heuristics, but the idea there is, and the obvious reason is, you're 70. You're either at retirement, in retirement, or about to go into retirement, and any decrease in your portfolio is going to be devastating to you because you're not going to have the time to recover. Even if the market bounces back in 10 years, it's still going to take a bigger hit of your portfolio, especially if you are at the same time drawing on some of that money or taking distributions, which you will have to do at age 70 because the Internal Revenue Service, in its infinite wisdom, has decreed that in IRAs and other employer-sponsored plans like the 401k, you're going to have to take what is called a required minimum distribution starting at age 70 and a half. Now, it's true, there are certain pieces of legislation that are potentially, that are in the works that might bump it back a few years or whatever. This is not the place to get into the ins and outs of that, but suffice it to say that the basic principle is that the IRS does not want to allow you to keep your cash in a retirement vehicle indefinitely. You're going to have to start pulling it out in most cases, and that's a consideration you want to address as well. Instruments that have high market risk, these are going to basically involve stocks, junk bonds, annuities that have variable elements to them. Moderate risk you might find with index funds, mutual funds, indexed annuities, and then vehicles that are going to have little to no market risk, although they certainly have institutional risk, little to no market risk. Those are going to be things like fixed annuities, certificates of deposit or CDs, high yield bank accounts, and this kind of thing. And once again, there is a relationship inverse between safety of principal and potential for market gain. And there is a direct relationship between market risk and the potential for gain. So if the higher the potential for gain, the more risk you assume at the same time. But once again, one aspect of risk that is not often considered is the risk of tax. So taxation is, I think, a risk that should be factored in when you're considering these things. And one way of viewing that is, what is the risk that taxes are going to go up? Well, the deficit right now is at $23 trillion according to the U.S. debt clock. We have $126 trillion of unfunded obligations or unfunded liabilities. and those things are just going up through the roof. And so at the present time, it seems like the very low tax rates that we have been seeing these last few years in terms of historically. 1970s, the highest marginal rate was 70%. Recently, the highest marginal rate has hovered around 37%. Now, that's not including things like the tax for Obamacare or other kinds of, maybe you want to call them hidden taxes, which can bump your effective rate up into the 40s. However, the main point is that with taxes being historically low and the deficit being historically high, many commentators believe that tax hikes are inevitable. If that's the case, then the question would be, how much money do you want to put into a vehicle where you're going to be taxed on it later as opposed to taxed on it now? And I can't answer these questions. I can simply put them forward for you as food for thought. If you want to dive more into these issues, and I really encourage you to do so, because, sometimes people will ask questions like, well, how long do you plan on being retired? I mean, it's a switch that once you throw it, are you going to want to have to go back to work after 5 years or 6 years of retirement or 10 years of retirement because your retirement income has run out, or because the cost of living has exceeded the amount of income that you're able to bring in based upon the investments that you have made, the retirement vehicles you have in place, the income streams that you have, including Social Security potentially. So if retirement is meaningful to you, and I'm not trying to sound funny here, but if you really want to try to ensure that your retirement is a plan that is workable, that your retirement plan is workable, you really at least need to have a minimal grasp of some of these issues, even though it is impossible to unriddle them entirely. And part of that is the reason that we don't know what's going to happen in the future. We don't know where tax rates are going to be. We don't know what the market's going to do. But at the same time, there are ways of sort of mitigating your risk. And I invite you not just to watch videos along the lines of this, but to really have a fruitful discussion and an open dialogue with money manager, with your insurance agent, with your investment person, your brokerage account manager, banker, a lawyer, an accountant. In another video, I talk about the 4 legs of retirement planning, and I basically in that video say you should have a conversation with a number of different advisors, and I invite you to click on that video for further information, because each of the advisors is going to have a different sphere of competence. They're going to be able to say different things to you, and in grappling with all of the information, hopefully your retirement plan will be better, more impervious to damage and danger and risk than it would be without those pieces of advice. So if you found something of use in this video, please like it, please subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you.